Even with all of the turmoil in the banking industry, the uncertainty ahead in markets, and the growing concern over a housing market crash, the Federal Reserve is likely to raise interest rates by 1/4 percentage point this week. And this would come just after regulators rolled out an emergency lending facility to halt a crisis of confidence in the banking system. In today's video, we're going to discuss all of that, and we're going to discuss its potential impact on the housing market. Let's go. The quote-unquote Fed put is back, with assets on their balance sheet increasing $297 billion over the last week alone. This is the largest spike since March of 2020. And if you take a look at when they started quantitative tightening back in April of 2020, they have actually reduced their balance sheet a total of about $626 billion. So this massive spike on their balance sheet is really taking away about half of the work that they've done over the last year. This is not quote unquote money printing per se, because the additional funding will be made available through the creation of new bank term funding programs, which is actually offering loans for up to a year in length. However, whether it be money printing or a loan, it's still adding liquidity to the markets. And moreover, these assets are valued at par, meaning it's going to remove the risk for banks and eliminate the institution's need to quickly sell those securities in times of stress. So why did the Fed jump in and act so quickly to help bail out these banks? According to Janet Yellen, the Secretary of the Treasury, if banks are under stress, they might be reluctant to lend. We could see credit become more expensive and less available. The idea is to remove the risk out of the markets and reestablish confidence. But despite the recent action from the Fed and the testimony from Janet Yellen, over the past week, money market funds saw their largest weekly inflow since the height of the March 2020 pandemic. They brought in approximately $121 billion, and this actually ranks as the second largest weekly inflow to money market funds since 1990. And this is essentially a flight to safety. The recipients of these large deposits are going to be the large banks. Bank of America, Wells Fargo, Citigroup, JP Morgan Chase, they've all experienced a significant amount of increases in deposits. And of course, the small and regional banks have suffered major outflows. According to Bloomberg, Bank of America actually raked in more than $15 billion in new deposits in just the span of a couple days. The reason this is happening is big banks are perceived to be safer because of their larger balance sheets. They're viewed as being systemically more important, suggesting that the government would actually come to their rescue in the event of trouble. Basically, they are perceived as too big to fail. The bank withdrawals and the movement of money has had nearly an immediate impact on the amount of credit availability in the system. And you can see here, according to this chart, that credit availability for commercial and industrial lending to small firms is already in decline. And if you go back in history on this chart, you can see that after the dot-com boom, we saw a decline. After the great financial crisis, we saw a decline, and then right after the pandemic started, there was a major decline. And now it looks like it's just getting started. Commercial and industrial lending is not necessarily the same as mortgage lending on residential real estate. However, as we start to see tighter lending standards among banks, it's going to impact loan growth, it's going to impact job growth, and it's likely to decelerate economic activity, which certainly is going to decrease the probabilities of a soft landing, and that will certainly reverberate through the housing market. Now, exactly how it impacts mortgage lending and the housing market, we can only speculate, but I could see an environment where lending standards tighten up completely. For instance, the underwriting guidelines may tighten, they may require higher credit scores, lower debt ratios, and more reserves, which could be an environment that impacts investors and those trying to purchase second homes the most. And the reason I think it could get more challenging for investors and second homes is because the Fed has indicated that they want to bring the housing market back into balance. So if you're a first-time homebuyer or you're looking to purchase a single family home as your primary residence, it may very well stay about the same because the Fed would like to encourage home ownership. And we know this because we're already seeing and catching wind of certain loan level pricing adjustments that actually improve the rates and pricing for first-time homebuyers. Despite all of the turmoil we are seeing in the markets, housing starts and permits actually posted a significant upside surprise as new residential starts rose by 9.8%, while permits increased 13.8% in February alone. The two main factors that likely contributed the most to this were going to be mortgage rates dropping to about 6% in the beginning of February, and then builder sentiment improved in recent months after reaching a bottom in December. It is important not to overinterpret 1 month's data because a similar spike in housing starts took place last August when mortgage rates dipped, and then of course they started to resume their downward trend until January. On the other hand, there are reasons to believe that we may have seen the worst in terms of a housing correction because the Federal Reserve has weighed in on their earlier than expected pause in rate hikes amid multiple bank failures last week. And one thing that I would like to add about new construction is that this very well may be the largest source of housing inventory that we see here in 2023. Because the markets have been rattled so much, there are many would-be buyers and sellers sitting on the sidelines. But right now, even though mortgage rates have started to come down, sellers still understand that many of them have locked into record low 30-year fixed rate debt hovering in and around 3%. And if they were to sell their property today, harvest the equity gains, they'd be trading up into a more expensive property with a significantly higher mortgage rate. And the point being is that there is less inventory than we typically see this time of year. So housing supply is very tight, making this a really great environment for new home builders. And you have to remember that new home builders know how to sell property. So they may have taken a little bit of a hit last year, but this is working out to be one of the best environments they could possibly be in. Now, why do I say that? I say that because the cost of materials are going down. There's very little existing home inventory that's hitting the market. So a home builder, they have the ability to control their supply. They can slow down their pace of building. They can offer rate buy downs. They can offer design credits. They can offer closing cost credits. Essentially, they can make it very appealing for the first-time home buyer or a potential home buyer to get involved in the market. And if the risk and uncertainty remains in the market and mortgage rates continue to trend down for here, that's putting home builders in a very, very good position. Remember, they don't look at this emotionally. They make business decisions. They're basing their decisions on margin. So as long as they can be profitable, they're going to continue to build and bring more inventory online. Speaking of mortgage rates, the volatility in the 10-year, which mortgage rates tend to track very closely, has been an absolute yo-yo. As of this recording, the 10-year treasury yield is sitting at 3.492. But if we just look at a 5-day chart, take a look at the volatility. This is really unprecedented. I mean, literally, big leg down, big spike up, leg down, spike up. It's just literally up and down and up and down. Mortgage rates have come down off their peak. They were sitting at about 7% roughly 2 weeks ago. The average 30-year fixed conventional mortgage today is sitting at about 6.62%. Based on where the 10-year treasury yield is today, these mortgage rates should likely be a little bit lower. However, I think that some of these lenders are being very cautious because of how volatile the market has actually been. Now, in addition to housing starts coming in stronger than expected, so did jobless claims. They actually blew past forecasts as well. They fell by 20,000, bringing us to a level of about 192,000. And this underlying trend still implies a strong labor market where jobs are plentiful and workers have little incentive to file for unemployment benefits. And this is likely giving the Fed cover or giving them more reason to raise rates at the next meeting here. One of the things the Fed has mentioned is that as they raise rates, they expect higher unemployment. How much does unemployment need to rise to reach the inflation target the Fed has of 2%? Well, as of this recording, unemployment rate is sitting at 3.6%, and full employment is considered 4.4%. According to this forecast and their research, if the Fed wanted to bring inflation down to 2%, they would need to bring the unemployment rate up to over 7%. Which of course would mean that millions of jobs would actually be lost. Now, if let's say they settled on inflation at around 3%, they're forecasting that that would bring the unemployment rate up to about 5%. Which would still have a dramatic impact on the number of jobs lost. Now, even though unemployment is still sitting at low levels, we have seen and are continuing to see more layoffs here, especially in the tech sector. These are the top 10 companies with the highest amount of layoffs over the last 4 months alone. And you could see that some of these companies made the list twice. So in other words, the first round of layoffs was not enough. You can see Google with 12,000 people laid off. Meta made the list twice, with the first round impacting 11,000 employees and the second round 10,000 employees. Amazon made this list twice as well. And without a doubt, these layoffs are absolutely going to impact their local housing markets. In fact, the San Francisco Bay Area actually saw one of the biggest declines in the median sales price over the last 6 months. And one thing that I want to bring to your attention is that when you look at these employers, what is the one thing that comes to mind? Well, for me personally, I think these are probably white collar jobs. They're in a professional setting. They require office work. They're likely very well paying. And I would venture to guess that many of these employees are homeowners. And if they were in a position where they purchased over the last few years, they likely locked in at super low rates. So they're going to do everything that they possibly can to remain in their home. But the problem is that if their income goes away and they don't have enough revenue coming in to support their outgoing expenses, they're going to be put in a position where maybe they're forced to sell. And if they have to sell, where are they going to go? Are they going to rent? Is rent's going to cost them more than what they actually pay on their mortgage? If so, that will put them in a tougher spot than where they actually are today. Or do they need to relocate to find more work or find a cheaper place to live? Or if any of those options don't play out, is it possible that they consider defaulting on their loan? And if they do, will the lenders and the government come out with new programs to assist with keeping people in their homes? For instance, some of the programs that we saw previously, like mortgage forbearance or loan modifications. And of course, we've already seen this play out already. FHA just published a final rule on a 40-year loan modification, meaning if a borrower is in default on their FHA mortgage, that lender or mortgage servicer will actually work with them, and there's rules and regulations around how they qualify for this, but they are willing to extend their loan term back out to 40 years to keep them in that home. And the point of all this is to say is that there are so many unknowns in the housing market. But one thing that we do know, and we have seen already, is that the government is working very hard to keep people in their homes, which means that we may not get that huge bump in supply or housing inventory that we would need to actually bring prices down, which may actually increase the probability that the housing market continues to grind along and it exacerbates the affordability crisis that we're currently seeing. At the end of the day, there are so many moving parts here in the housing market, and there is so much intervention coming from all of these different angles. It's hard to predict with any level of certainty where the housing market is going. So I would love to hear your opinion on the market and where you think that we're going to be headed here into the future. Please leave a comment below, but that is going to wrap it up for today's video. I hope you found this information useful. If you're new to the channel, consider liking, subscribing, and sharing. It really helps grow and promote the channel, and I'd certainly appreciate it. Thank you so much. Have a great day. Take care.